Test, test. There we go. Okay, I'm hopeful that everybody on Zoom can hear me. Tested my microphone, tested my speakers. Give me oh, there's a chat. Give me a thumbs up if you can. Okay, great. I got it. So you can hear me. And it's 5:31, so we'll get started. Thank you for zooming in, showing up. It's beautiful outside. Tonight we get to talk about lease accounting and pension accounting and accounting for different kinds of tax treatments, which is I don't want to say it's the most boring lecture of this semester. So I'll just say you did pick a good night to show up, because what I can say with certainty is that it is the most technically challenging. So if there's one lecture you do kind of need to be here for that it will be the most beneficial, it's chapter 10, because this is material that is just not necessarily intuitive, takes a couple run-throughs to grasp. I'm really going to urge you to watch the accompanying videos that come with the text, because I'm going to have to motor. These three topics are all very dense and very technical. And I don't know what was wrong with the authors on the month they decided to put these three in the same chapter together, but we got 76 PowerPoint slides that we're not going to be able to get to all tonight, and it's all on complex stuff. So I'm going to try to hit the highlights, urge you strongly to back this up as soon as you can. Go reinforce this with the material that's in the book, watch the videos, and get to the homework as soon as you can. That's going to be the best way to begin to commit some of this to memory. It's the most complex chapter in the book. Alternatively, you might say to yourself, well, I can whiff on one. I'm not going to pay any attention to this. Concentrate on the other three that'll show up on exam number 3, because I'm comfortable getting a B or wherever I am in the class, and just check out. It appears as if we have some students in the class that made that second decision. No judgment here. So before I jump into it, what questions, if any, do you all have of me on the exam, on the research project, on the homework? All okay? All right.
Will you be checking your numbers and break about it? Try to crush something.
Yeah, no, I'll be around.
Great, so.
Yep. Yeah. If I'm a little bit slow with something that you need, go ahead and follow it up with a text, and I'll get to it sooner rather than later. Okay. Now, let's see. Okay, well, my pointer's not working, but no big deal. We'll just do it the old-fashioned way. Okay, we're gonna start with lease accounting. I'm gonna point out, probably to my embarrassment, should be to my embarrassment, some of the things that I struggle with in accounting. And if they can help you to not be embarrassed at some point in the future, great. Learn from my mistakes. Leases. The most simple concept of identifying a lease is the difference between a lessor and a lessee. I have always struggled with which is which. I don't know why it is so hard to get through my thick skull. Here's what I use. The owner of the asset is the lessor. Both of those words have an O. So if that helps you, then use it. The owner is always going to be the lessor, and both of those words have an O. The renter is the lessee. So anybody in here rented a car? No car. Okay, great. So you have a pretty good understanding of how that transaction works. Everybody else in the class probably has a good understanding of what it means to rent a car. You sign a piece of paperwork that says you're going to drive the car off the lot. You usually write them a check up front. Then you write them a check every month until the 36-month or 60-month lease is up, and then you take the car back and the dealership keeps the car. Leases are really a pretty simple thing. They only get complicated when they become a de facto purchase. And that happens all the time in business. What does it mean when I say de facto purchase? It means that at the end of that 36 or 60-month period, the lease was so expensive, whoever the lessor is has already made their money, and they offer you a bargain purchase price. That's silly. Like, okay, well, now if you want to just keep the car at that point, you pay $500 and the car is yours. So when you enter into a contract like that from day one, FASB says that according to GAAP rules, you really just need to call that a purchase. Because if you call it a purchase, then you have the whole asset. If it's a $20,000 car, you got to put that on your balance sheet. If you call it a lease, you don't have to put it on your balance sheet. If you call it a purchase, you got the asset on your balance sheet, and more importantly, you have the liability on your balance sheet. So for a long time, you'd see companies kind of play games with constructive or creative leases in a way that would keep those assets and, more importantly, the corresponding liabilities off their books. But if you knew how the accounting worked, you could peer through and look at the 10K filing and the fine print and the footnotes and the disclosures. And you could say, take a company like Southwest Airlines. They have all their fleet of airlines set up on leases. That's huge. That's huge. If you take all those assets off their balance sheet, what are you left with? A shell of a company. So the analyst would look through and they'd say, I call shenanigans. These aren't leases. These are purchases. I want you to put those on your balance sheet as assets and liabilities. And it won't surprise anybody in this room to hear that FASB has some rules that we need to be aware of. And those rules, surprise, surprise, give management teams some leeway in selecting the treatment of the accounting between operating lease and finance lease. And therefore, we all need to be on the lookout for how that accounting might be manipulated. Other highlights in the first slide is this is a private contract. I've pointed that out several times in this semester. So many of the things that we look at are private contracts. We had a big conversation about that a few weeks ago when we talked about bonds. When you have a private contract, what that means is that any condition, any covenant, any interest rate, any other feature, any deliverable between those two parties can be drafted into that contract. So we have a broad framework for accounting for these, but you also need to recognize that they come in an infinite varieties of forms and flavors. Okay. Touched on all those. Okay, now the authors of our text, they do a good job of contrasting the old accounting treatment from the new accounting treatment, but this text is 6 years old. And the new accounting treatment was launched almost in accompaniment with the last version of the text. So at this point, it's not so much new anymore. So if you go back to 2019, it was crucial that you recognize the difference between the way operating leases used to be accounted for and the way they're accounted for today. Today, it's probably not going to affect anybody in this room unless you're looking at financials that are dated 2019 or before. So keep that in mind. It's becoming less and less relevant that we take a deep dive into the history of accounting. So I'm not going to do it. I'm not going to lecture on it, but I wanted to point out that it's there. And if you are looking at a company this semester that has a large lease expense on their profit and loss, and you're trying to compare the operations of that company across time, and you notice a big change right around 2019, this might account for it. So be mindful of that. Otherwise, I wouldn't expect it to have a big impact on your just general analytic frame. For our purposes, the existing accounting differentiates between finance leases, which you can think of like a purchase, i.e. that asset, that car, that plane, that whatever has been financed and purchased. That's how we're gonna treat it. With that comes the accompanying interest rate. We're gonna have to figure out what the interest rate is on that, just like we would if we bought a car, there'd be an interest rate. And then there's usually an amortization schedule associated with that. So for leases, because that's not always given to us up front, we have to learn how to back it. Operating leases are a piece of cake. We do not treat that as a purchase. We do not record the asset on our balance sheet. We do not record the liability on our balance sheet. On a monthly basis or on a quarterly basis, we simply record rent expense or lease expense. Okay. You're gonna see me skip a lot of slides tonight. That is partially because this module is so dense and I have a lot of material to get through, and partially for reasons like the one I just addressed. We have old accounting treatment. This is how you should expect to see the leases reported on, this is Microsoft's balance sheet. You can see here that underneath total current assets, that first highlighted line, we have finance leases, but that's actually jumbled together with the line item that says property and equipment, which is exactly what you'd expect if we're going to treat it as a purchase. It's no different than any other purchase. All the property that we own has been purchased. Some of them have associated mortgages or leases. That'll be in the liability section of the balance sheet. There you go. Right underneath that, you see operating lease right of use assets. So these operating leases do show up on the balance sheet. So just a minute ago, I said they don't show up on the balance sheet. I take that back. Take all those words, stick them back in my mouth. What you're observing is me getting confused between the old accounting treatment and the new accounting treatment. So under no circumstances does FASB allow for companies to keep those leases off their books. Okay, liability section of the balance sheet, just like you would expect. Any accompanying current or long-term portion of debt associated with those operating leases is going to show up on the balance sheet. Here's what you need to look for when we're drawing the distinction between a finance, i.e. purchase lease, and an operating lease. The criteria, I used one called a bargain purchase option. If at the end of that lease, they're practically giving it to you, that's a de facto purchase. These are the other criteria that we're going to look at. Transfer of ownership. If there's no bargain purchase option, if they're just giving it to us, well, that's a finance lease. Purchase option, we talked about that. Lease term, if the lease term is 90, 95, 99% of the usable life of the asset, then that's a purchase. Present value, if the present value of some of the lease payments exceeds the residual value, that's a purchase. Specialized asset is a broad category that could apply to a lot of things. If it's a I don't know, piece of mining equipment that has no other use after the lease, that's a purchase. So that slide I was just on there would be a good one to come back to, likely to show up in a multiple choice type question. Okay, let's talk a little bit about how we record that lease liability on the books. When we record that lease liability, we need to know these 4 items. The amount of the lease obligation. To that, we're going to add lease payments made to the lessor at or before the lease commencement date. When I was talking through that car rental, there's always an upfront payment. And I love the way car rental places get you for the low price of $399 a month. And in the fine print, it says, plus an upfront payment of $25,000. Oh, well, that's a great deal. So we want to make sure we factor in any of those upfront payments. Subtract any lease incentives received from the lessor or owner. So that would be like cash rebates in this example. plus initial direct costs of the right of use asset incurred by the lessee, so tags, title, insurance, fees, that type of thing. If we're talking about an automobile, that equals the right of use asset. So the balance sheet presents the lease liabilities and the asset. We just looked at that. The finance lease is typically going to lump that into property, plant, and equipment, and then the operating lease assets and liabilities are each reported on a separate line item, as we just observed. You will find in the 10K a schedule of lease payments. For a company like Southwest Airlines, you need to be thinking about this as similar to the same schedule we looked at a few weeks back that showed debt payments coming due. For everybody in this room that's analyzing a company, we all are, I've advised that you need to be familiar enough with the companies that you're looking at to know and understand how they're going to pay their future debt payments. So if in 2025, 2026, 2027, they have debt issuances that are due, they're going to have to find that much cash, and that shows up on these tables. So if you need to write a check for what could be 10 billion, 20 billion, 30 billion dollars, how are you going to come up with that money? Add whatever you owe in debt to these lease payments, because these are contractual liabilities, no different than that debt conversation. So they belong in the same place. You need to be thinking about them in the same place. These are, again, these are individual contracts, so they can have as much weight and bite and teeth to them as anything else that a company engages in. And what I mean by that is that if a company can't afford to pay these leases, there might be collateral associated with that, which could bankrupt the company. The consequences can be severe. That's all in the fine print of the 10K, or the 10K will inform you on where to go to get more information about those. Interest rate, typically given, but our authors walk us through an exercise whereby if we know the sum total of the payments associated with lease and the total, the present value of those payments, i.e. the assets value today, then we can use an IRR formula and back into the discount rate. Okay. Lease accounting and the income statement. Now we're looking at the total expense over the lifetime of the lease equals the total remaining lease payments plus amortization. Let's walk through this example. Second bullet point. Assume, for example, a company executes a 5-year lease requiring annual payments of $22,463. They pay an initial direct cost of $5,000. So these numbers are roughly fall into the range of a good auto lease. Not quite. It'd be a pretty damn nice auto if we're paying 22 for 5 years. So that's $105,000. What kind of car sells for $105,000? Cadillac SUV. Okay, not anything I've. We're going to buy a Cadillac SUV on a 5-year lease. We agree to pay $22,400 every year, and the dealer charges us $5,000 down initially. So we know that the present value of those lease payments at 4%, see, interest rate given, typically given, is $100,000, and the company recognizes a lease liability for that amount. Okay, great. Now we got an asset on our books at $100,000 and a lease liability on our books for $100,000. The only problem is we paid $5,000 up front, so we have to add that to the right of use asset, the Cadillac in this case. So it's not a part of the liability because we already paid it. You could lump it into the liability, but you immediately paid it, so cash goes out the door and lessens the value of the liability. Now we have an asset on our books that's $105,000. So the total lease cost under both operating and finance leases over the life of the lease is $117,000. So this is our annual payment times 5 years plus $5,000 of upfront costs. Now, how we account for that under operating and finance is going to be a little bit different. Under operating, there's our lease expense every year, easy. Under financing, we have to go back and say, well, we know 4% of that payment is interest expense. So we have to record it as interest expense. We know that if we bought that asset, we would be recording some type of depreciation or amortization. So we're gonna have to record that as part of the expense. Basically, we're gonna take that lease expense and divide it into a portion of interest and a portion of amortization. How do we do that? Well, we know the interest rate is 4%. So with a financial calculator, we can take the lease due, multiply it times 4%, and the interest component of that is a little bit easier. The amortization component is the leftover. Let's look at that. Okay, operating lease expense, easy. 117,000 divided by 5 years, 23,463 per year. Financing lease, a little bit more difficult. For year one, our lease expense is 100,000, which was our lease liability times 4%, plus 105,000 divided by 5 equals $25,000. 105,000, remember, was the value of the asset. It was 100,000 plus the $5,000 initial upfront fee for a total of 105. We divide that by 5 years equals 25,000. So the amortization and interest expense now need to be identified. You know, which is which? Did we do that already? No, yeah, I guess it's just that simple. Okay. This portion, 100,000 times 4%, is the interest expense. What is that? That's $4,000. 105 divided by 5 is, what is that? 21 something.
It's 25 total, gives you 4,000.
4,000 plus 21,000 equals 25,000. Thank you.
I got you.
Yeah, ding, 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 ding. I love it. Okay, so if this is 4,000, then this has to be 24,000, and we've just solved for both interest expense and amortization expense, and that happens to equal what the operating expense would have been. So now we have identified the difference between operating, lease accounting, and finance lease accounting. Statement of cash flows. Well, for an operating lease, that's all going to go in the operating section of the statement of cash flows. For a financing lease, it's going to be a little bit different. We have financing cost, interest expense. We all know that interest expense can go into the financing portion of the statement of cash flows, or at least the principal portion. In the statement of cash flows, the interest portion can go in operating, and then the net cash flows from operating activities will therefore be higher. I don't want to speak out of turn, but I've never seen this one be material to any analytical work. But it's important that you know if you're divvying these up differently between the statement of, on the statement of cash flows, between the section of operations, investing, and financing, there's going to be differences in accounting caused by the classification of operating versus finance. Okay. Moving on to 21, star this page. It's basically a summary of everything that we've just been over tonight. So that'll be a good one to come back to. And that is all I have to say about leases. Just about perfect timing on that. Yes.
In regards to leases, you also said that you put in like the taxes and tags and stuff into the vehicle. Does that not get pulled out to then be put into taxes, or do you just kind of lump them all together? Like a tax expense? Or is that too like critical, I guess, to say? Is that too?
That's a great question. I imagine that there's flexibility to do that either way. It is a manner of detail, and there is some flexibility about how we account for these major purchases. What you typically see is all those minor fees get bundled into the cost of the asset. Okay, pension disclosures. We touched on this a few weeks back. I mentioned the example of my grandmother, who's 92. My grandfather died in 2002, so he's been deceased for 22 years. She's been drawing on his pension. He retired from Phillips 66 in 1985. Phillips 66 had promised him a paycheck for life, basically. That was a pension. These used to exist. You don't hardly see them anymore, but maybe you all know somebody that's still drawing a pension. The military is a good example. You work 20 years in the military and then you get a pension where they send you a check in the mail. Pretty good deal. Well, corporate America used to be loaded with these things, and they would use them to incentivize new employees to come work for them. And my grandfather went to work for Phillips 66, and he was a pipeline engineer for years and years and years. Worked, I think the minimum requirement for a full pension was 35 years. So he put his 35 years in, retired in 1985, drew on that pension for his lifetime. It was also good for the lifetime of his spouse. So they've been sending either him or now my grandmother, after his death, a check in the mail every month. So what is that? 1985, gotta use my fingers. 95 would be 10 years. 205 would be 20 years. 15 would be 30 years. We're almost up to 40 years worth of payments. Now that was a contract between Phillips 66 and my granddad. So while he's accruing rights to that future stream of cash, those future checks that are going to show up in his mailbox, Phillips 66 also has to record on their balance sheet a future liability. They know today that they're going to owe that money. So this is the conversation that we're getting ready to have around pension accounting. And your mind's probably already beginning to anticipate how complex that is when you have to calculate the likelihood that you might owe a portion of your workers their compensation into the future for a period of 40 plus some odd years. He only worked for the company 35, and they pay him for another 40. That's a terrific deal. So let's look at this. This is one of the reasons why you don't hardly see these things. But and it's not because people like my granddad and grandmother bankrupted the system. Actuaries are smart enough to look at the planned population, and they're going to know that 2% of the people in our workforce, this is going to happen. So the math will allow you to facilitate these things. The real reason why you don't see them anymore is that corporate America got a little bit greedy, and I'll show you how this works. If you're you know, anybody remember the nursery fable, the little red hen? Okay, well, the little red hen was this prudent little chicken who used to go around, and she saved all her pennies and prepared for the rainy day. And the moral of the story was, you know, you just need to be prudent about your operations, and okay, whatever. Well, corporate America, they got a little bit far afield when it came for properly saving for these, because as we'll observe, if you want to rob Peter to pay Paul, you can save some expense by failing to properly fund your defined benefit pension plan. So that's a good short-term strategy if you're trying to line your pocket and present good numbers to Wall Street and potentially trigger your own options package. It's a terrible strategy if you want to properly fulfill your obligations to your workforce that you promised over a period of decades. So we saw a couple of huge bankruptcies take out thousands of pensioners, and the whole system just kind of began to topple. So you don't see defined benefit pension plans very often. What do you see in their place?
401ks.
401ks. Those are called defined contribution plans, and the difference is in the name. In a defined benefit plan, the company promises the benefit. It's usually defined as X% of your salary on average over your final 3 years with the company. So if you work till 65, that promise becomes your average salary in year 63, 64, and 65. And it's usually 80%. So 80% of your average salary when you're 63, 64, and 65 years old should be enough to sustain your lifestyle till you're dead. A defined contribution plan is much different and doesn't require any work by the company. The first one requires all kinds of work by the actuary because they have to make some big time assumptions about how long you're going to live, what you're going to be making when you're 65, what the inflation numbers are going to be, so on and so forth. A defined contribution plan requires nothing of the company other than we're going to give you X. They just have to define X per paycheck. Most companies define that as X% of your salary. We're gonna contribute. We're gonna match. Could be just an outright contribution, 3% of your salary every pay period. A lot of times you'll see this show up in the form of a match. Now we're gonna contribute or match 3% of your salary up to the first 3% or 6% to try to facilitate savings. These are all good mechanisms to get people to save more, and people do need to save more because we have a retirement plan crisis emerging in this country. The average, I'm delving a little bit from our text into what I do on a daily basis, but I think it's interesting. The average account balance at or near retirement is $170,000. These are people who are 65 years old. If you're between 63 to 70, your average and median account balance is $170,000. $170,000 will produce, call it $12,000 a year. You go out, you buy an annuity, that's about 6%. So that's $1,000 a month. Add that to median Social Security at about $42,000. And now you're at $52,000 in annual income. The median income for a retiree, if you're at 65-ish in the United States, is closing in on $70,000. So we're asking the typical retiree who has a $70,000 lifestyle to retire on $50,000. Basically, that's what we've just asked America to do. That doesn't work. So you can take, what is that? That's a 1/3 cut to your standard of living if you're just going to take it out of expenses. Or you can work approximately another 5 years. Either one of those levers would solve that problem. And it's a big problem because people who face it vote. 60-year-olds vote in higher percentages than any other decade. So politicians are very focused on this number, because it will get them elected or it will get them punted out of office. And we see all kinds of new legislation coming, trying to facilitate the savings. I think what you're going to see in the near future is mandated savings. So in a defined benefit plan, what you saw were companies saving on your behalf. You didn't have to do anything. I think in the future, we're going to go kind of sort of back to that, where it's still a defined contribution plan, but the government mandates forced savings. So now the company.
Do that whenever the payment. As much.
Yeah, it just comes out of your paycheck.
Well, but that's what I'm saying, the inflation rate is getting out of hand, where what our grandparents made, your grandfather, what he made does not match what I make coming out and the cost of living now. So if they mandate something like that, I don't know if that's possible to expect college students coming out of college making $40,000 a year, and they're gonna mandate us to save it, but we can't even pay our rent on it.
It's a problem. So what you hear from me are not my personal political beliefs per se. This is me reading the political landscape and the tea leaves and making prognostications about what I think will probably happen. If it does, I would expect cries from other generations saying this doesn't work for us. In which case, the legislation probably gets very cloudy and murky, and you get forbearance periods and student debt relief and try to make accommodations.
Do you also feel like they're doing that because Social Security is at a crisis for our generation? Or future generation?
Yeah, depending on how you look at it, if Social Security is closer to being funded, what's really at crisis is Medicare. If you look at the funding status of Social Security, that'll probably go bankrupt by 2040 to 2025, 45, somewhere in there, without any adjustments, just on the trajectory that we're on. So we'll make adjustments. That's not gonna happen. The Congress will get together and they'll say, well, Social Security is at full Social Security is at 67 today. Let's just raise that to 70. And they buy themselves another 10 years of funding status. Seems reasonable. I mean, when Social Security was first launched in 19, I don't know, pick a year, 32. You don't know, so prove me wrong. Google's at your fingertips. It won't take long. When was Social Security? I do know this. The first recipient, her name was Ida Mae Smith, and that's probably 60% right too. So Ida Mae collected Social Security, which started at the age of 62, and I think that lasted. Actually, I think Ida Mae was one of the best recipients of Social Security. I don't think she ever contributed but a day in her life and drew on it for the next 30 years. So way to go, Ida Mae. The point I'm trying to make is that when Social Security was launched, the average life expectancy in the United States was 62. So we launched a program that was meant to be longevity insurance. And we basically told America, hey, if you live past 65, we're going to write you checks. Okay, well, that seems like a workable system when the average life expectancy is 62. We're not promising everybody a check. Well, today the average life expectancy is 82. So today we're promising 15 years worth of checks to the average American, whereby when the system was launched, we were promising -3 years worth of checks to the average American. So what we have over time is benefit creep, and people don't realize the magnitude of that benefit creep. So if we just reset and said, well, let's go back to the original intent of Social Security, make it longevity insurance, that'd be horrible, because we would destitute a whole generation of Americans who have been relying on that benefit creep consistently for decades. But I think we'll get some adjustments. Medicare is a different issue, and that's a big problem because it's a huge expense, and it's a huge expense, not altogether because Americans are getting old, but because we have other problems with our healthcare system. And I am less than zero qualified to comment on that problem beyond what I've already said. Okay, let's see here. I covered 27, I covered 28, accounting for defined contribution plans. I'm not going to cover that because it's just so simple. You treat it just like salary expense because it's a defined contribution. Now, accounting for defined benefit plans is different and subjective and complex and requires a lot of estimating and requires you to employ a full-time actuary, so on and so forth. After you jump through all those hoops, here's the nomenclature that we need to be aware of. The first one is projected benefit obligation. This is the liability that's going to show up on your balance sheet and takes into account the full weight of all of the estimates that we make with regard to our employee base, how long they're going to live, what their salary is going to be at the age of 63, 64, 65, what percentage of that salary we're going to pay them out, and for how much time we think we're going to have to pay that out on average. It's going to be 10 years, 20 years, 30 years, 40 years, like in the case of my grandfather. The major inputs include number of employees, salary level, years of service at retirement, years over which the annual payments will be made, and then we discount all of that back to time zero, meaning today, to show a current liability on our books. We're going to compare that liability, that projected benefit obligation, to the plan assets, which is easy. Plan assets is just simply the CFO logging into his Fidelity account or Schwab account or TD account or JP Morgan or Goldman Sachs or wherever you keep the money, looking at the balance of the investment portfolio that's meant to fund this liability, and the difference between those two numbers becomes your funded status. And this bull market that we've been experiencing for the last few years has bailed a lot of companies out of some pretty poor numbers. When you look at that funded status, if you go back and look at a history of funded status over time, when I first started teaching this class 10 years ago, average funded status for the S&P 500 was in the mid-60s. Not very good. You work for a company that has a funded status in the mid-60s, you should be a little bit worried about collecting those checks. So your all's assignment for the companies that you're doing research on this semester is to A, find out if they even have a pension plan, and then B, find out what the funded status is. Okay, so that's plan assets. All those. Oh, funded status. So here's the mark. Yeah, see, I told you the bear market had bailed this out. So if you go back, oh, this is 18, so 10 years ago when I first started teaching, it looks like it was a little higher than that, about 76. But significant, you can see how it fluctuates with the markets. And that's a problem as we're going to look at next, because some of these pension plans can have associated assets and investment portfolios numbering in the tens of billions of dollars. And if you have call it a $50 billion investment portfolio and the market drops by 30% like it did in the great financial crisis, you just lost $20 billion. And FASB says, if you put a $20 billion loss on your income statement, your profit and loss statement, you just turn that whole statement into something that's meaningless, because it will dwarf the operations as reported of most companies in the S&P 500. So let's make some rules that allow us to smooth that out. You've heard me talk about other comprehensive income. This is one of those. This is one of those places in accounting where we will put the fluctuation in those plan assets down in the statement of other comprehensive income. So you get to, you go to the income statement, you got revenues, top line revenues, then less expenses equals operating income, less interest, less taxes equals net income. Net income is the bottom line. Well, surprise, surprise, the bottom line is not the bottom line. There's something underneath the bottom line. And what's underneath the bottom line? We call that comprehensive income. Comprehensive income is something that I refer to as the basement or the junk drawer. This is all the stuff that we don't want on the front page of our income statement, but is very meaningful to the economics of the companies that we follow. So all this stuff goes into the junk drawer. So your job becomes look in that junk drawer, see what's in it, see if it's meaningful. And we talked about that 2 weeks ago, so I'm not going to go into detail there. But do find this table, which will show you the major muscle movements of a defined benefit pension plan, how the assets have fluctuated over time, the funded status, so on and so forth. As with everything else we talk about in this class, there's always going to be a table in the back of the 10K filing that gives you more detail. And that detail should disclose materiality, which is always important for an analyst in everything that we do in this class. If it's not material, quit looking at it. Then it will also disclose additional detail. So if it is material and you need to do some digging and find out what are the levers that are driving the movements in these numbers, how are they affecting my margins? What, if any, estimates and or discretionary accounting treatment has the management elected and why? Then these tables will often provide you a lot of detail, and on this table, you can see the actual return of plan assets. So you can see that funded status has varied with market return. Company contributions, that's huge because you can see how the company's contributions have fluctuated over time. Just a minute ago, I gave an example of defined benefit plans kind of going by the wayside because some of corporate America had chosen not to fund those assets. Right here on this table is where you get information about whether or not they're funding them. Benefits paid, settlements, and other. Yes.
With pension plans, do they fluctuate the way, like, per market? So when they're paying out, so like say in 2007 when the market crashed. Did they pay less out for that year or that time? Or did they have to stay consistent with paying out?
We gotta stay consistent. Yeah, so that's,
So I was, I'm
Yeah.
not sure if like, picking, you know.
yeah, so you can see how challenging that would be to actually set up one of these things. You have to be an investment professional, which this is what I do. You know, when we set up an investment account for a pension plan, we're gonna stress test that plan. So we know in advance. If we have $1 million portfolio or $100 million portfolio and it's meant to meet this stream of assets, we're gonna look back and stress test that portfolio and ask ourselves, what if this portfolio had been set up like it is in advance of the great financial crisis? And then we'll show the client, this is what you would have had to deal with. And the client will decide, yeah, okay, we can write that out. That's a risk that we're willing to take. Or the client might decide, no, we are not willing to take that risk. We want to immunize this portfolio. And that is actually my preferred way to manage a pension portfolio, because the term immunize means you're either A, going to hire an insurance company to take all of that risk, pay them today. Insurance is insurance, right? So you're going to pay more for that risk transfer. Or B, you're going to ladder a portfolio to perfectly match the future stream of liabilities that you expect to owe from that pension plan. How would you go about doing that? Well, we know that our estimates are set up as such. And I'm just going to pick random numbers here. We're going to owe $1,000 per month for the next 20 years. Well, if I have an investment portfolio, I can go out and I can buy a CD that will mature and pay me $1,000 per month for the next 20 years. So that's 12 CDs per year times 20 years. That's 240 CDs. If I go buy 240 CDs that are laddered to mature every month for the next 20 years, I've immunized that portfolio in a way whereby I don't ever have to worry about this anymore. I'm no longer subject to market risks. And usually you see companies say, well, gosh, if we can benefit from market returns, which have averaged 9 to 10% a year over time, we're going to greatly benefit over the 2 to 3% rate of return we get if we go out and immunize this with CDs. So you see companies take on a little bit of that risk. That's what gets them in trouble. Okay, 36. Was there anything I wanted to say on slide 36? No. No, down to slide 39. And on slide 39, I want to focus your attention on nothing more than terminology. When you dig into the fine print surrounding projected benefit obligations and fund status, you're going to see some terms listed right here on the bottom half of this slide. Service cost. So service cost is nothing more than the money that you owe from your employees accruing another year of service. So in the example of my granddad, when he was a 50-year-old man and he worked a year, and now he's a 51-year-old man, well, he's accrued benefits. He's got another year of service. He's another day closer to that liability that's going to start paying him. So that factors into our math. We call that service cost. Service cost is going to drive up your projected benefit obligation every year. Interest cost. Well, the projected benefit cost is a present value. You all know the way the present value math works. We take the future stream of cash flow and discount it back. When we discount it back, we use an interest rate. So there's an interest rate embedded. That liability will naturally grow in lockstep with that interest rate year after year after year. That's usually disclosed. Return on plan assets and actuarial adjustments. Return on plan assets is an easy one. That's just whatever the market return gives us. And then periodically, we'll have actuarial adjustments. So the actuaries have to keep track of how long do we think everybody's gonna live. If they decide that everybody's gonna live longer than they previously decided, then they gotta update the whole equation. And in doing so, you could see some big swings in that projected benefit obligation. And again, whenever you see big swings in that projected benefit obligation, FASB is typically gonna allow us to put that down in the junk drawer. When we do put it down in the junk drawer, as you'll see in a minute, FASB has some rules for how we amortize that over time. So eventually, we pull that back up to the income statement so that we can show it as a loss or a gain, whatever the case may be. But we want to do it in a way that makes the income statement meaningful and usable. So for pension costs, we call that smoothing. FASB will allow us to smooth those costs over time. So service costs, interest costs, investment returns, touched on those, actuarial adjustments, a few other varieties that you see there, wage inflation, years of benefits, so on and so forth. Here's that smoothing mechanism I mentioned. So to allay some of these fears associated with that volatility, we will smooth pension expense. And we do that by taking large investment gains and losses on pension assets, putting them in the junk drawer, and then changes in the PBO that arise from estimates and actuarial assumptions, put those in the junk drawer too. Okay. This concept's a little bit more technical, but it's brief. Okay, but we're talking about smoothing. When we get those large variations in the value of the PBO, how do we smooth those? So we're going to amortize the excess of any deferred gains or losses. What do I mean when I say the excess? Well, we're going to start from an assumption that the fair value of these assets, the investment portfolio that powers this pension plan, is going to earn X. What is X? 6%, 7%, something on par with a historical average. Here's the key point. Management gets to pick X. Okay. So if management gets to pick X, we should immediately key in on the notion that shenanigans could be at play. And you all should go to the back of your 10K filings and find out what the expected return is. Because if the expected return is 25%, you got a big problem. That's not reasonable. You want a reasonable expected return of 6-7%. And if the market generated that year in and year out with consistency, there would never be any smoothing. There would never be any excess deferred gains or losses. But we know that the market doesn't always generate a historical average rate of return because by definition, an average of 10, yes, sir.
I hate bothering interrupting you. Do you have keys to the classrooms?
No, would it be best for you if we called an end to class and just got out of here?
No, that's cool. No.
I tried.
What do you guys discuss?
Deferred pension benefit obligations and the smoothing nature of their accounting.
I need to sit down on this.
I don't have keys.
There's nothing going on. I mean, if you want to call class, I can call. But no, we just, they redid this building
Yeah.
a couple of years ago. Well, when they rekeyed it, they didn't give us the keys to it. And now someone's locked out somewhere and we have no way to get them. So that's why I was thinking maybe.
No, I got that. Sorry.
Key to the classes. Sorry. Apologies.
No problem. Have a good night. So we're going to take the difference between that expected rate of return and the actual rate of return. We're going to stick that in the junk drawer and we're going to amortize that over time. Here's one I wanted to comment on, and the only comment I made myself in prepping for class tonight is just wow. Every time I come in contact with this accounting, my response is the same, which is just wow. Companies have the option to forego the smoothing mechanism that we just talked about and elect fair value accounting, which is exactly what it sounds like. If we lose $20 billion on our pension fund, we're just gonna cram that thing through the income statement today in what's called fair value accounting, which creates the same problem that we were trying to avoid. It creates the same problem that FASB was trying to avoid when they initially created the smoothing mechanism to begin with. What do you do with that income statement? Well, fortunately, we've all been educated now in fair value accounting, and we know how to make analyst adjustments to an income statement, so we can take that off of the income statement, put it down in the section of other comprehensive income, and recast those financials as if they were consistent with every other company. AT&T is the only example that I've seen. You can see what happened in 2013 there. They had an $8 billion gain from their investment portfolio. So made them look great in 2013. I'm not really sure how the market reacted to that, but just know that exists. Okay. I think that's all I want to talk about as it related to pensions, and yikes, left myself 20 minutes to talk about taxes, which is not enough time. But let's do it. Analyze and interpret income tax reporting. Okay, what you need to know about income tax reporting is that every publicly traded company will keep at least 2 sets of books. What do I mean when I say 2 sets of books? Well, one set of books is the traditional accounting governed by generally accepted accounting principles, practices. The second set of books is a completely different set of financials and financial statements that are delivered annually to the IRS for tax purposes. And those books don't have to match. They have to reconcile. We have to be able to know how you get from point A to point B, but they don't have to match. So the expenses can be different, the net income can be different. It's really just the tax expense that's different. And I'm going to show you a couple of instances whereby they don't match. And the reconciliation is going to show up as a line item that we label deferred tax asset or deferred tax liability. And I'm going to ask for your grace. Deferred tax asset and deferred tax liability are 2 concepts that I don't have any tricks for, and I can't get straight in my own head. So you will see me like, give me that moment where I'm like, I will say this wrong. I will say deferred tax liability when I mean deferred tax asset. It's been a 20-year challenge for me to keep these 2 things right because it's technical. Because you're dealing with 2 sets of books. So let me see if I can't lay it out there in a way that allows you all to benefit from some of my past stupidity. The most intuitive example of this is to look at these 2 sets of books and analyze a single transaction and how the accounting treatment is different from one set to the other. So we're going to look at the recording of depreciation first, and we're going to compare straight line depreciation, easy, to an accelerated method of depreciation. And before we jump into that, I should probably back up a little bit and just go high level. If you had the choice, which you do have the choice, why would you elect one accounting treatment for GAAP and another accounting treatment for the IRS? So by GAAP gives you the flexibility to use straight line or accelerated depreciation. Use whichever one you want. The IRS gives you the flexibility to use straight line or accelerated depreciation. Use whichever one you want. Why would you make those different? Well, for one, we want to use straight line, and for the other one, we want to use accelerated. And it's completely your choice to elect the mismatch. Why the mismatch?
Give you a different profit versus loss. Where you are, depreciation.
Yeah, your city management team is gonna get together and they're gonna say, hey, dummies. What? Well, obviously, we wanna elect the accounting treatment for the IRS that allows us to pay the least in taxes. Which one is that? Okay, great. And obviously, we wanna elect the accounting treatment for GAAP that allows us to report the most in net income. So you have competing commitments there. You want low taxes, you want high net income. You got different kinds of accounting treatments. If it works to your benefit to solve for both of those goals by electing different accounting treatments, you can bet that's the way management is gonna do it every time. Good. So in this instance, you can see here on this chart that we have straight line depreciation in red. It's the straight line, obviously. Then you have accelerated depreciation in purple. That comes down over time. And there's a pretty significant difference between the expense we're going to record in year one. You can see that in year one, we record, that's the purple, we record an accelerated depreciation expense of $200. In year one, we record a straight line depreciation expense of $100. Okay, which one of those are we going to use for the IRS? We're going to use the higher one. We want that expense to be as big as we can possibly make it, because that's going to make the income that we report to the IRS as small as we can possibly make it, and that's going to make the tax we pay on that income as small as we can possibly make it.
Can you switch them? Like once you've started it, say it's a 5-year depreciation. Can you switch it in year 3 on which one you would want to fire? Or do you have to just keep the same one? Does that question make sense?
Yes, it does. You would have to refile your taxes.
For the years previous?
Yeah,
I was just asking, because I feel like. If
It's
they're
a
gonna
good-
go with one.
I feel like you're pulling on a thread that a really creative accountant could make some good advisory money with, but I don't know enough to advise you on how that works in
I was
practice.
just asking if they
So-
could switch it in year 3 to make their books look better, or if they just have to keep the same one till the depreciation is.
So one of the challenges there is that if you record this depreciation down to here and then switch it, you will have recorded more depreciation than the asset is worth.
But then could you lessen the asset amount by, then you would have.
You can lower the asset amount until you get to 0, and then you're probably in fraud territory.
I was just questioning, I just didn't know. if-
No, it's a good question, because I don't know what opportunities, if any, there might be to game this system. And I know that's the wrong way to describe it, but it's kind of the right way to describe it too, because, you know, what. I don't like the word loophole, because it implies shenanigans. What I prefer is incentives. If they're, and yet those two things can be exactly, say that again.
We'd like to find the loopholes.
Yeah, or incentives,
Make
yeah.
their books look better,
Yeah.
so,
I think the more traditional way of doing it is just to keep getting more assets that you're
and
getting
then,
with that double declining balance. Or that accelerated depreciation schedule, so you always have a deferred liability. And you're never really paying as much tax as you quote unquote should have.
That's a really good point. And as you get into practice with some of these larger companies, global companies, you could see this decision made at the asset by asset level. I don't know that. You don't typically see that, but. Now, the accounting software is sophisticated. But that's an interesting question. You stumped me. Well done. Okay, let's run through an example. Okay. On the left, we have financial reporting. So this is going to be our straight line. On the right, we have tax reporting. So this is going to be our accelerated. You can see that the depreciation, income before depreciation in both instances is $200. The depreciation for financial reporting, which is straight line, is $50 in year 1. The depreciation for tax reporting, which is accelerated depreciation, is $75 in year 1. That makes our income before tax 150 for GAAP, 125 for IRS, which is lower. That's what we want. The income tax multiplied by the income before tax leads us to our income tax expense. So we have the cash paid of $50. This is what we owe the IRS. We will pay the IRS $50. For GAAP purposes, we're going to show a tax expense of $60. But we only pay $50. So we're going to record a $10 entry to, I'm going to flip a coin and go with deferred tax liability. Because we're going to owe that difference at some point in the future. We haven't paid the cash yet. As of today, we only paid $50. There's a $10 difference, so we know we're going to have to make up for that at some point in the future. That becomes a future liability, and we're going to label that deferred tax liability on our balance sheet to plug the hole. And you can see exactly how it's entered here. So we have a $50 credit to cash, a $10 credit to deferred tax liability, a $60 credit to retained earnings, and a $60 debit to tax expense. That will reverse itself in the following year when we have, this is a very simplistic example, so 2-year depreciation cycle. It reverses, and you can do the math yourself, but you can see that our tax expense becomes 70. I take that back, taxes paid, the cash out of our wallet is now 70 because that basic transaction is reversing. But we only show a $60 expense on our GAAP statements. So the difference therein is 10. We're going to record a $10 debit to our deferred tax liability, and that's going to zero out that account. So very simplistic way of looking at how a deferred tax liability ends up on the books and is ultimately reversed out. Now, the way most of your companies are going to work is that they have operations going on all over the globe. They'll have thousands of these. Their accounting software will distill it down to one gross entry, and they'll report that on a table in the back of the 10K file. And you can see the major muscle movements disclosed in association with that, just like we've talked about many times. Let's talk about a deferred tax asset. So depreciation is the simplest transaction to understand how a deferred tax liability ends up on the balance sheet. How does a deferred tax asset end up on the balance sheet? Well, that would be an instance whereby the cash we pay to the IRS today is higher than the tax expense we pay that shows up on our GAAP financials, accruing to us a future benefit, and therefore we would record a deferred tax asset. Restructuring costs are an example of that. There's two examples that the authors give are restructuring costs and net operating loss carryforwards. Let's look at restructuring costs first. So you see here in the third bullet point that for tax purposes, restructuring costs are not deductible until paid in cash. For GAAP purposes, restructuring costs are deductible immediately, but that restructuring plan might unfold over the period of 2 to 3 years. So over that period of 2 to 3 years, we're going to have taxes that we owe to the IRS that have already been deducted on GAAP. So that is going to result in a deferred tax asset on our balance sheet. Net operating loss carry forward is another common example when companies incur a net operating loss, a net loss. They can take that and offset it against future income. So if we have $1 million loss today, next year we have $10 million worth of operating profit, we can take that loss, subtract it from operating profit next year, and only pay taxes on $9 million. So that's an expected future tax benefit that will show up on our balance sheet as a deferred tax asset. So net operating loss carry forwards can be extremely valuable. And for companies in the emerging stage of their life cycle, I just looked at a company today called Sage Medic, really interesting company, biotech. What they do is, like say you get diagnosed with cancer, breast cancer for the sake of argument. You can take a sample of that tumor, send it to Sage Medic. They will grow that tumor. it's called an assay. So they'll take it and they'll put it in the right environment, petri dish, I guess. And they'll replicate it 100 times over. So now you have 100 little samples of this tumor. And they'll take every little sample and they'll expose them to, say, the top 20 medications, and then another 50 experimental / off-label medications that have been shown to work in a small subset of patients. So now you have 100 tumor samples that have all been exposed to different medications, and they're going to give the doctor a report back that says, on this specific person with this specific tumor, we know that these medications have been shown to work the best.
They did that already on, bacteria. Human ones.
Oh, really? Okay.
So.
Well, I thought it was,
These work for.
I thought it was-
They
I thought-
swab it, they send it
Right.
off to the lab would send it back and say, this is what it is, it's a compilation of this, these medications work the best to kill this, and then you look through it. Then you decide which one was the best route.
Okay, so same thing for
So
cancer.
that-
Really cool stuff.
Yeah.
The problem with this company is that they're startup phase and they're just burning through R&D dollars. So it's year 1 loss, year 2 loss, year 3 loss, year 4 loss, year 5 loss. And if they make money in year 6, they're gonna have 5 years worth of net operating loss carry forwards to deduct against their taxes. Now, this is so prevalent. What you see in the world of mergers and acquisitions are profitable companies going out and looking for target companies to buy that have huge net operating loss carry forwards on their books. Because if you're a profitable company, you can take all those net operating loss carry forwards that may or may not ever benefit the target company. Buy that company, transfer those assets to your books, and immediately get a benefit that that target company might not ever have been able to realize. So they show up in the world of mergers and acquisitions, and it's really interesting kind of the way they change the value and future economic benefit for the acquirer. And I have 3 minutes left. Let's see. Okay, 66 might be my last point. When you see large deferred tax assets on the balance sheet, a company will have to be profitable in the future, like that net operating loss carry forward I just mentioned. That's worth nothing unless the company is going to be profitable in the future. So FASB says there's got to be some estimate about the realization of that. What is the profitability? And if you look at a company like Sage Medical, and they're not forecasted to be profitable for the next decade, FASB says, we're going to make them take an offset against that deferred tax asset. That might be a rather large asset on their balance sheet. We're going to make the company disclose that they don't have profitability in their future sites, and therefore they've recorded a valuation allowance against the deferred tax asset, which is basically the company saying, this asset's not worth what it should be because we don't have a path to profitability. So if you see a valuation allowance booked against your deferred tax asset, raise a little pink flag, raise a red flag. That's a big problem. And I think that's it, gang. Yes. Class adjourned. Thank you. Wow, we did it. And you did it when it was gorgeous and 70 degrees outside. Really appreciate you coming. I hope it was to your benefit. This is technical stuff. Please watch the videos that come with the text and hit this homework sooner rather than later while it's a little bit fresh in your mind. Because I know this stuff's complex. So that's all I got. Thanks, Zoom crew. You too.